Helping Seniors Television, all about improving quality of life for seniors. If you're a senior, know a senior, or plan to be a senior, then this show is for you. It's all about helping you develop your own aging plan so you can age actively and with dignity. Helping Seniors Television from the Helping Seniors Network of information, education, and resources. On today's edition of Helping Seniors TV, let's learn about reverse mortgages and how they work. Used correctly, they could be a valuable financial tool. Let's join Helping Seniors TV program host and longtime senior advocate Joe Steckler as he talks this topic over with Brevard County-based Barbara McIntyre of Reverse Mortgage Funding.
This is Joe Steckler, and this morning my panelist is Barbara McIntyre from the Home Reverse Mortgage Funding. I always say the title wrong, Barbara, but it's Reverse Mortgage Funding. I get it right.
That's right.
But I think what's important to know about the show today, we've done several shows, folks, on the reverse mortgages, and people call them all kinds of things. The important thing is that you get the right information and you get the person that really knows the product, because it is not for everyone. It is for some, and for some it can really help them. For some, we've never really talked about this, but it could probably get themselves in a lot of trouble if they got themselves into a reverse mortgage with that wasn't going to help them, it was going to hurt them.
Exactly.
Yeah, and I think one thing that you told me this morning, Barbara, was extremely important, is that while there are probably hundreds of thousands of home reverse mortgage offices throughout the United States, there are only 156 board certified specialists like you are.
That's correct. I'm very proud to say that I'm a certified reverse mortgage professional, which is a designation that I took a lot of time to achieve through the National Reverse Mortgage Lenders Association. And I am the number 156.
You're the 156th one?
I am, and it required a lot of years of experience in originating. That means meeting with borrowers and then of finalizing a loan, as well as many, many hours of continuing education, and then tests specific to the reverse mortgage product. So I felt it was after 13 years of originating, I really wanted to have that designation.
Well, what I like about what I've known about you in the years that I've known you is that you do a lot of work to keep yourself abreast of the field, the changes.
That's right.
And that's really important. It's just like a good attorney. You just don't pass the bar and make what happened 25 years ago apply today. In most cases it does. Once you set a precedent or you got a case law established, then it holds.
Right.
Okay? But they cite that. But in the case of spending somebody's money or making money available to do something with it, you get a lot of change. And you have to really know what you're doing, I think.
Absolutely. And every person that originates loans, whether they work for banks or private lenders, mortgage brokers, they originate all types of loans. I always say forward loans because the nickname of my product is a reverse mortgage. So forward loans are things like conventional loans. Everyone has a national loan originator certification. We've taken national exams, state exams for whatever states we're licensed in. That licensure is about all mortgages. So my mortgage, the HECM or the reverse mortgage, is so specific and so unique that my designation is taking my national licensure as a loan originator like everybody has, and taking it a step further to be just specific and specialized for the HECM. So,
well, is it fair to say that when we talk about reverse mortgages, home equity loans, everything, it all comes under the heading of a reverse mortgage?
Well,
or does it?
People call the product a reverse mortgage. There are some reverse mortgages that are done for real high valued homes, $1.5 million, $1,500,000. That might be what we call proprietary reverse mortgage, only offered by a couple of lenders and not insured by FHA. However, in today's market, the only reverse mortgages done for your average home values, when I say average, could be from a $90,000 manufactured home up to a $636,500 single family home, because that's the lending limit. That would be the HECM, and that is the only reverse mortgage out there.
So you specialize in home equity
Conversion mortgages.
which is a HECM?
HECM. That's what it's really called and has always been called. We just got a nickname of reverse that stuck.
What then exactly is a home equity conversion mortgage?
It is a way for a homeowner who is 62 years or older to tap into equity in their home without the requirement to make a monthly payment. They can make a payment anytime they want, but they're not required to. So that mortgage gives them the ability to have access to home equity to help them in a variety of ways. Age in place, use for needs for home health care, do home repairs that they wouldn't otherwise have the money for. My favorite is position in a line of credit and then tap into it in the future years, because the line of credit has a growth feature and gives them access to more and more equity over time. So the benefits and features of the HECM are unique to just this mortgage, and they are varied. There's a lot of different options. You can use it as a monthly income stream. So that's why with this mortgage product, it's very important to preferably sit down with someone to educate you about it, not try to gather all the information over a telephone call.
Okay, we can talk about all the good things that a HECM can do.
Right.
But when you get into the business of money lending, rates, how you make your money on 401ks and all this stuff, there's got to be some good things. There's got to be some bad things. How can a person get themselves in trouble with a HECM?
I would say the one thing that I really want to review with a potential borrower is what their long-term goals are about as they age. Is part of their plan the possibility of going into an assisted living facility? Because when you leave your primary residence, which is what you're getting a HECM on,
Right.
A reverse mortgage is tied directly to your primary residence. When you leave that residence, either by deciding to move or by dying, that's when that loan is called due and payable. And if you have taken out a reverse mortgage on your home and you started to use those funds, that equity, and then you make the decision to go into assisted living, then you would sell your home. If you have been using the equity in that house, that might have been what you planned in the future to use to get yourself into the assisted living facility. And in that case, I think the client needs to have a view of what their life looks like for the next 5 years. Now, no one has a crystal ball, so when I'm talking to a potential client, that's what I say. Some people will say, oh yes, my plan is definitely to move out of my home and go into assisted living. And at that point, I might say, well, maybe we can look at other options for tapping into what you need today, versus putting a HECM in place and then drawing more than you might need. But for most people, if they say, no, I want to age at home, I want to have resources right here in my house, then there really isn't a downside from my point of view. The loans are structured in a way that you can actually obtain them much cheaper than you ever could in the past.
Okay, let's say if a person had a home that they could take a HECM out on in a value of $200,000. And over the years, they used that money to fix their roof, they used it to pay bills, or maybe they gave money to their children that they got in trouble. And out of that $200,000 HECM, maybe they'd used $150,000. What happens then if they try to sell the home, or what becomes their responsibility at that point?
Okay, if they decide they want to leave their home at any point in the time of having a reverse mortgage, then they would do two things. They would look to what is their current loan balance that they'd get from their servicer. They get mailed a statement every month. They'd look at that statement and they'd see, oh, our loan balance today is $150,000. Then they'd call their realtor and they'd say, what would our house sell for today in the open market? And the realtor might say, oh, well, now you said the house was worth $200,000 when they obtained the HECM, so you would assume that that house probably has experienced some appreciation.
Okay.
But even if it didn't have any appreciation, and it was still only worth $200,000, but now they owed $150,000, they would go ahead and sell their house. And then after paying their realtor fees, they would have $50,000 less the realtor fees.
So they'd have to pay $150,000 out of the sale of the home.
That's right.
To pay. Okay.
Whatever the balance is. Now, the thing that's really unique about the reverse mortgage, which makes it a very special loan, is that because it is insured by FHA, if the loan balance had been let's say the loan balance had been $150,000, but the loan balance had been $150,000, house had depreciated.
Okay.
Instead of appreciated. Let's say the house was only worth $140,000. Something happened in real estate and the house value dropped. Now the borrowers are insured by the FHA. They literally have no obligation to take another asset they have to pay back the difference in what's owed. That's because the lender will now go to HUD, FHA, and say the house was sold for the $140,000. They owed $150,000. We need $10,000 more.
So the government would pay that.
The FHA Mortgage Insurance Fund. We can say government, but the truth is the Mortgage Insurance Fund, FHA's fund, is paid into by every borrower who does FHA financing. Everybody who does an FHA mortgage pays in upfront mortgage insurance premium, and then they pay, first-time home buyers make a payment every month, and it includes additional mortgage insurance premium. That is what creates the Mortgage Insurance Fund, which is what insures FHA loans.
So regardless of how you look at this,
Yes.
it's going to cost you something. And there's no free ride, there's no free lunch. You can elect to take the money in a reverse mortgage or in a HECM. You can elect to take that money out to make your life easier. Let's say if you got a leaky roof, you can fix the roof if you got equity in your home. And what that means is you just have less money to either give to your children or to use for your own assisted living facility care if you would need that care. But let's say that over a 10-year period, you might have taken this thing out and cashed some of the value when you were 75 years old. The chances of you outliving that are 50-50. But instead of living in a leaky house or living in a situation where you need more money to take care of yourself to make your life a little bit easier, you, in effect, have just tried to, you had a way to make your own living a little easier.
Absolutely. And that's what it's really all about. And it's not just about our senior retirees. It's about our boomers who are retiring.
Right.
Because everyone is experiencing the same thing in our world today.
Yep.
We're living longer. Costs continue to go up. We know that health care is going to be the biggest cost we face in the future. And what we're realizing is we have to have a resource to add to retirement planning in order to have what we need to take care of that.
Well, you know, in talking to you on these shows, I've learned that in talking to other people that are getting older, that are even older than I am, and that's bad. These people try to plan for the future.
Sure.
but they have Social Security.
Right.
They may own a condo, and that condo may be worth $200,000. It's paid for, and they got X amount of dollars in savings, and they have their 401k from the corporation maybe that they used to work for. You could assume they probably have a month with the home paid for. They probably could have a monthly income of $3,500 or $4,000.
That would be nice. I work with a lot of people who have lesser income than that.
Oh, I know. But if a person has full Social Security of roughly $2,200 a month, and they have a decent, and they've worked for General Motors or Ford or some of the companies that did have pensions, they bought them out, and they either put it into a 401k. And a lot of people, the older people, were frugal. And
oh, your generation far better prepared themselves, Joe.
I know.
And your generation absolutely knew what to do, and living frugally. They shouldn't have to live as frugally as many do. But as far as being prepared and seeing the future and putting things in place to help that work, your generation is far better than the ones coming behind. Now, in fairness, some of the ones coming behind thought we were doing the right thing, but the markets didn't cooperate, and we didn't know to get out and get back in. We just did what we were told, which was it's a retirement account. You don't need it until the future. Just keep writing it.
Well, the same thing happens with today's market, Barb. We don't know how long this market's going to hold up. If it tanks and we lose something, I always heard people say, if you don't have the money to put it in investments, if you can't afford to lose it, don't do it.
That's right. That's right. And so people in retirement now, what they're doing due to market volatility is they're taking money out and sidelining it, I hope, because they don't have the ability, they don't have time now to wait for recovery, even though the markets have come back nicely just in recent months. Who knew that was going to happen? And a lot of people never took advantage of this last rise. More importantly, is that we know healthcare is going to be this huge, big thing in the retirement of boomers. And housing wealth is what many boomers really do have. And learning about the features of the HECM and how it can actually be put into place at early instead of waiting until the end of your monies. Right. If put into place early, the feature of a growing line of credit, which, I talk about this all the time because it costs little to have. It's not going to cost you anything if you don't use it. It's all still your own equity available right back to you when you sell your home. But as it grows in its ability to give you access to more and more of your own housing wealth, when you do have a health event, or when one of the two of the couple dies and income is immediately reduced, you have a resource sitting there waiting for you to use. And people's fears, and this is the most basic, there are still so many people out there that think that when you do a reverse mortgage, that means you're selling your home to the bank, or that somehow the bank owns your home, or that there will be no money left for your kids. And all of those things are not accurate. And so my mission is always just educate.
A thing that it just dawned on me while you were going through that is that if I take and put myself in a position where I take, and my wife and I did talk about this after one of the shows you and I did. Mm-hmm. We thought about putting the money into that, into the conversion type thing where you talked about putting your money away and then drawing against it should the need arise.
Right, line it just, yeah.
But the thing is, if you do that and you use some of that money, mm-hmm. you pay it back at a much lesser cost to you than, say, if you would have taken money against a credit card or if you'd gone against a bank loan.
Absolutely.
So, see, these are the little nuances that
right.
when you talk about a reverse mortgage per se,
right.
you don't think about all the little intricacies, the ins and outs of how an experienced mortgage person like you can help the uninformed understand more about what they can do, and in the long run save themselves money.
Absolutely. And it's funny you say that about the using that to borrowing against it at a lesser rate than if you borrowed against a credit card. I have to be honest, I really didn't think much about that. That just popped in my mind and I went, wow, you're absolutely right. Because the feature of taking a reverse mortgage line of credit and being able to pay it back, take it out, put it back in. Take it out, put it back in. So if you do have a need and you do want to go ahead and take some funds out of that line of credit at a much lower rate than a normal credit card would be charging you, you can always pay the payments back in, put it right back.
Because most
so
senior
makes
citizens,
sense.
a lot of the elderly people, Barbara, one of the things that we're finding out in our work with helping seniors is that one of the greatest needs seniors or frail elderly have as they get older are roof repairs.
Yes.
And they don't have the money on hand to fix the roof. Now, you can go to a roofer and that roofer might tell you need a whole roof.
Right.
Or you can go to maybe somebody that's a little more honest when it comes to making money in roof repairs and say, you don't need to do that extensive repair. You need to do something that's a lesser repair. But you can take that money. You've already got a program where you can draw from it. You could take that money, pay for that that repair, and slowly pay it back.
Absolutely.
Or
not pay it back.
Or
You don't. It's your money. It's just tied up in the brick and mortar of your house. Nobody says you even have to pay it back, and that is for anybody in retirement. If somebody said you have an option of having this mortgage debt that requires a monthly payment, that if for some reason you can't make that payment, you're at risk of foreclosure, or you have an option of this mortgage, they're the same, they're just a lien interest on your property. You can make payments as much or as little as you want, anytime you want. But if you don't or can't make a repayment, you don't ever have to. All you have to do is pay your taxes, homeowner's insurance, live in your house as your primary residence.
That's an important thing. You have to live.
You have,
in that
and it's
residence.
always your primary residence.
It's got to be your primary residence.
But you're not tethered to the house. You can travel. You can be gone for extensive periods of time. You can even leave your house because you have to go into rehab and be in rehab for a number of months. As long as your physician says you're going to be able to get back into your home, that loan won't be called due. So you have many protections.
Yeah.
And to me, boy, if I know I'm in retirement and my income now is relatively fixed, why would I take on any debt that could jeopardize me staying in my home due to a required
Well, that's
payment?
the beauty about the HECM.
I think so.
You're borrowing your own money.
That's exactly right. And you know, your kids are great, but you have a right to have a good life, a healthy life, and have what you need.
And this is where so many people, as we get older, we say, okay, I'm not going to borrow against that because my children are not going to get $100,000 because, or maybe they're not going to get $200,000.
Right.
So what the heck difference does it make if they get $146,000
right.
instead of $200,000? I can live in a dry house. I don't have to worry.
Right.
Maybe my car needs fixing. And maybe I needed some medications that I did.
And if those folks ask their children and let their children know what their needs really were, 9 times out of 10, those kids would say, are you kidding? Absolutely do the HECM. We don't want the house. We don't want that money. We would far rather know that Mom and Dad, you guys have what you need today. You helped us get through college. You helped us start our business. You were there for us the whole time. We don't need anything more from you. You take care of yourself. You take the trip to Europe or whatever. The kids most of the time will say that.
You're being a little bit of an altruist there because
I live that way.
There are a lot of children.
There are some.
There's some that want to get as much from Mom and Dad as they possibly can.
Some.
I know.
You know what I say to those when we're sitting around the kitchen table and the kid's going, I say kid, but he's, 40, 50. And he says, oh, Mom, I really don't think you need. And I'm like, I have the perfect solution. how much is it that you need to have every month to make the ends meet? And she'll say 600 or 700. And then I'll say, okay, son, can you send that check?
Yeah.
And then he's like, oh, let's go ahead and keep talking about this product.
Well, there's just a lot. There's just a lot that you can do.
Yes, there is.
That we don't do. How long have these mortgages been around?
Oh gosh, the HECM was put into place by Ronald Reagan. The FHA insured loan was actually put into place. He had the foresight to know where we were headed, and so that's how long it's been around.
What do you think has been the greatest single thing that the government has done in regards to HECM to protect both the HECM and protect the people themselves if they use the HECM maybe a little incorrect? What's the greatest single protection thing that's been put in place?
It's hard to come up with a single one, but I would say...
I know what it is, but I know what I'm thinking.
I'm going to say what I think. Right now, we now have a way that we actually do a light underwriting of the borrower to make absolutely certain that they have the ability to continue to pay taxes and insurance, so that we don't actually help them get into a loan that could default because they couldn't pay the taxes and insurance. And that's a recent thing just in the last 2 years.
And that's part of it. But
that's one of them.
That's one of them. But I think the other is the fact that the government has insured
Right.
this loan.
Okay.
So I think that you went, and several of the things, and you made a great point of that, is that you're not going to get yourself into a lot of trouble unless you really work at it.
Right. So to that point, because it is FHA insured, you can live in your house for as long as you want to, and as long as you pay your taxes and insurance, regardless of how the debt grows. So, you're not at risk of foreclosure. So
we
that's
always
a pretty
run
good...
out of time.
Okay.
We always run out of time. But I want to thank you, Barbara, for the
you.
show today, and I hope that I hope our listeners have been a little better informed about what a HECM is, and we'll be doing more shows on this in the coming year. So. But if you got a question, you can call our office at 473-7770, and Kay can tell you how to get in touch with Barbara.
Thanks, Joe. Always
You're
good to
quite
see
welcome.
you.
Thank you. I'm Joe Steckler. Thank you for joining our program today. I'd like to remind you that our senior information line is available to you at 321-473-7770. There you can get help and direction that could be helpful for your specific situation or circumstances. The work of helping seniors is very important, but we can't do it alone. That is why our sponsors here in Brevard County are so important. I'd like to thank our many area sponsors, businesses and medical providers who support the mission of helping seniors that help us carry the cost of our media efforts. If you'd like to join us either as a business partner or simply donate as an individual, we would welcome your call at 321-473-7770. You are always welcome to visit our website at www.helpingseniorsofbrevard.org. Thanks so much for your help. It does make a difference.